Thanks for doing this.
Yeah.
I think this is going to be a good conversation. Obviously, with the Inflation Reduction Act passed, there's a lot of buzz in our industry on what's going on, and I think you and I want to have just a conversation on battery storage today.
That sounds great.
So let's start there.
Yeah. So John, what are the differences between doing tax equity for storage and doing tax equity for generation?
Well, other than the asset itself, obviously a battery can charge and discharge, and solar relies on the sun and wind farm relies on the wind blowing. The batteries, where it gets really interesting is on the offtake arrangements. There, in the solar and wind space, historically, we've done busbar PPAs, we've done corporate PPAs, we've done all different sorts of hedges that have been out there. But with batteries, particularly in places like ERCOT, lots of sponsors really would prefer to run their projects on a merchant basis. However, for tax equity investors, that presents a challenge. They really look to finance contracted revenues. So they look for long-term contracts, anywhere from 7 years and up, maybe even in some cases 7 years is too short for them. On the flip side, a lot of the sponsors' investment committees also are uncomfortable with fully merchant assets. Not all, but some. And so that has been driving the market to figure out how can they get tax equity financing and as well get a contracted revenue and the projects still look very attractive for them from an economic standpoint. And so there's been some products out there that are developing some fixed shape hedges, some insurance products, and then of course you have more traditional agreements like a tolling agreement and items like that. But the trick is going to be to sort of find how I can run my battery on a quasi-merchant basis, and I think that the commodities market is going to have to help with that. But I'll turn it back to you. I think also one thing that could help is if they don't have to raise traditional tax equity and they could take advantage of this transferability market. And so I'd love to hear from you how you think that's going to develop over the next several years here.
Yeah, absolutely. So the IRA gave us this great new tool in our monetization toolkit for tax credits with the ability to sell tax credits to a third party for cash consideration. And that really opens up some great opportunities for storage projects, standalone storage in particular, where you can sell your tax credit without needing to worry about the investor looking for that revenue profile that they're so used to that you described. So you can monetize your tax credit with an investor who can be indifferent to the revenue profile. And that's a great benefit from the IRA. There are, of course, some disadvantages to that compared to traditional tax equity. In particular, you don't get a chance to monetize the tax depreciation. So that could be a big difference between how those projects end up economically viable versus the traditional wind and solar.
Do you lose the depreciation fully, or is it you would need to be able, the sponsor would need to be able to take it themselves?
The sponsor would keep the tax depreciation, but of course if they don't have the ability to utilize it because they have a lot of net operating losses that they're carrying forward, which is quite common in renewables, given that all of the renewable technologies get accelerated depreciation, and we've been in a bonus depreciation scenario for several years. And batteries now, as a result of the IRA, get that accelerated 5-year depreciation.
Right, so we would be in a situation where I can just, if I place my battery in service, I can sell off the investment tax credit, and that buyer is just a buyer of tax credits and will have no say in how I run my project. So if I want to run my project on a merchant basis, I can just do that and then still be able to monetize the ITC, maybe having to leave the depreciation unmonetized, or perhaps like the sponsor can monetize it themselves.
Yes, and perhaps they'd have to carry it forward into the future and monetize it a few years down the road, which makes it slightly less valuable, but still an important tax benefit.
Right, and the other interesting thing about that is if you do a transferability deal, it gives you the ability to do term debt at the project level rather than having to do these traditional back leverage deals that we've done, because you'll just have a tax credit buyer. They won't be in a partnership with the sponsor. They're just a buyer, and then we can go ahead and call it front leverage at the project level, which also could be attractive because the lenders are closer to the asset and will allow we know that lenders are allowing for fully merchant portfolios of batteries to be financed. And so that could also be another attractive tool as a result of this transferability. So you get some of the tax benefits and you get a fully merchant project that is debt financed.
Yep. Now, we do need the tax credit transfer market to develop, and there are a few things that are holding that up right now. Part of that is the statute allowing for the secretary to put some procedures in place to prevent duplication, and we don't yet know what those procedures are going to be. So until we get guidance from the IRS, I think a lot of the potential players in the tax credit market are sitting on the sidelines waiting to see how onerous those procedures are going to be. But once those come out, I think we'll start to see people move into the tax credit transfer market. There will, of course, be a discount on the tax credits, so that's another downside versus tax equity. But it does create so many tremendous opportunities with these things we've been talking about here, particularly for standalone storage.
And if I'm a buyer of the tax credit, will it just be as simple as on my return that I say that I've bought a tax credit from project X, Y, or Z?
We don't know yet, but we expect that there will be a fairly straightforward reporting process of that tax credit and probably some system for tracking from the seller to the buyer.
So Anne, in a transferability deal where you transfer the tax credit as opposed to a third-party tax equity deal, one of the things I've been thinking about is if there's an ability to step up the basis, the tax basis in these transactions. If I just do a direct transfer, am I stepping up the basis in that scenario?
No, we're used to in tax equity having to do a development company and operating company structure so that there can be a sale that steps up the basis and unlocks all of the value that's inherent in that property. And we do need that in the tax setting to create basis. We need a realization event that steps up the basis. And if we're just selling from the party that has generated the tax credit to the party that is going to own the tax credit and utilize it, we don't have that sale that is unlocking that value. So in just a straight transfer, it would not be stepping up the basis. There are probably ways we could structure to step up the basis, like using a cash equity investor on the seller side. But then that brings us back to many of the issues that you were talking about before in the revenue profile and getting an investor comfortable with those sorts of issues.
Right, and so if you're looking to step up the basis, you probably are looking at some other form of partnership on the other side, assuming you want to also be a long-term owner of the asset. There is probably some other type of partnership, and obviously if you're entering into a partnership with a cash equity investor, a tax equity investor, that brings everything along with that in terms of voting rights and just managing the asset. And so
that's right. You need two different regarded taxpayers to be able to have a sale that steps up the basis. So that means we need to be introducing those third parties into the mix.
And probably not the end of the world. We have quite a few sponsor clients that do sell down a portion of their cash equity interest in the deal anyway. So maybe it's just sort of reinventing a structure that's been tried and true for several years. But it's an important point, because if you start looking at it, if you're not stepping up the basis for an ITC deal, and then you're not monetizing depreciation, you really need a pretty strong purchase price on the transferability credit to probably make them pencil out the same way.
That's right. You're leaving some value on the table there, so you need to make sure that you're getting the most bang for your buck with transferring the tax credit.
Well, Anne, this has been a great conversation. I appreciate it and truly enjoyed it.
Me too. Thanks, John.